Today is December, I believe is December, today is December 20th, 2015. This is Frank Clueless 8. This is a free advanced coaching webinar and a market update for next week and going into the end of the year. This session is being recorded and will be published on the Clueless 8 YouTube channel for people who have missed, for them to review, and for current people to go ahead and listen to at their own free time. Full disclosure, this is purely for financial education and not for any solicitation or advice. So let me kick off. A couple of observations, very important observations, obviously. When markets do what they do, and in 2 days we lose more than 500 points in the market, it does not matter what technicals are. All of a sudden, that massive cloud of gloom and doom and emotional apathy, pure despair, no question in my mind. Okay, I see that in my members. I feel that in the waves of sentiment across the board, in the media, you name it. It doesn't matter. You can't turn anything on without listening to the fact that this is it, this is the end, and all kinds of stuff. And there's nothing wrong with it. My job, and I've been doing this for years, my job as somebody who runs the service is to try to project what I believe, and I could be right or wrong, it's just my personal opinion, what I believe to be factual, informative information that I can produce for my members and free trial subscribers. The emotional trauma that people generated by people looking at their immediate P&Ls, looking at their Friday P&Ls or their Thursday P&Ls is really not my business. There are members who come and go. There are free trial subscribers who don't become real members, and then a lot of new people who sign up. That's just the way life works. My job is to try to be as objective as possible, as disciplined as possible, and try to make sense of what happens on the front side. Whether I'm going to be wrong or right will be revealed in the form of people's opinions and what they do with listening to me or staying with the service or whatever. And so far, since the inception of my service, since April 15th of 2014, I'm very grateful and humbled to say that we have had resounding success with a lot of people who have basically come and stayed with us, come and gone, and still remain with us. And thank you. The bottom line is the markets are markets, and we have to understand what is going on. So I'm not here. I just want to make it very clear. I try as hard as possible to be a motivation, to be a leader in trying to put things in perspective when it's the darkest. There's an old saying, it's darkest before dawn. And the reality of the situation is that regardless of what happens, there are certain times things just implode. Just it seems like that because it's just a ferocity of the move. We've gone through it so many times, and I'm going to show all that tonight because past lessons have to be continuously remembered, reviewed, and understood. One of the key things about human behavior is we never learn. We never do. There is the people say that people change their behavioral, people change their nature, or they go ahead and change the way they think. They never do. The best you can do as a human being is you can adapt. You can adapt. If you're a real jerk, you can adapt to be a nicer person. If you're a really evil person, you can adapt to be a lesser evil person. If you're a good person, you can try to be better. And if you're somewhere in the middle, you always strive to adapt to be a little bit better. It's the same thing with investing and trading. There is no difference. Okay? The cognitive bias, which plays a heavy role, and I have to repeat this, which plays almost a 90% role, I would say, or a good 80% in our trading decisions, in our investment decisions, they never change. People, based on their life experiences, from their investment experiences, are either bullish or bearish, period. Either they have a bearish bias or they have a bullish bias. They're never neutral. The market is never neutral. You will never open the Wall Street Journal any day or turn on CNBC and or Bloomberg and expect them to say, "Oh, it's a neutral market. Everything's good. Let's go buy the heck out of the market." Never. They never say that. And the bottom line is, when things are moving higher, it's the same old story. Okay? So what I'm trying to put together is this. And I've reviewed, and everything that I say, I've undergone myself. So that's the difference between me and some other genius out there, or faux genius out there, who thinks they've developed a method to completely harness the market at all times. Nobody harnesses the market at all times. It's a game of probabilities. You can as long as you harness the market 70% of the time and benefit from it, you're way ahead of the game. Did you know that more than 30% of mid-sized hedge funds blew out this year, and that some of the largest ones have stopped taking in investor money and trading the markets? And this has been going on for 2 years now. And they're the best of the best because they just don't get it. So no one's saying that what I do is better than those geniuses out there. I'm simply saying that throughout all this, I've managed to come ahead and come out ahead. And that is a pretty damn good feat. So point is that when you look into your own brain and try to figure out what you're doing right or what you're doing wrong, first and foremost, you have to realize that at any given moment, it is not the market, it is you. And I speak to myself. I'm talking to myself when I say this. I'm not standing on a pedestal preaching like some fanatical evangelist or some mullah out there. I am talking real stuff here. Okay, ladies and gentlemen? So please listen carefully, because I don't care how smart you are in your own business and how brilliant you are on a one-day basis, okay, or a two-day basis. I told you so kind of traders, okay? I will tell you that, in my opinion, that 99% of the time that you fail to accomplish what you were doing with a certain trade, short, long, or short, is because you didn't act. It is better to act and fail than never to have acted. And that is the God honest truth about this business. And believe me when I tell you, I would rather be wrong by following a technical discipline based on what I see out there than be right by saying, "Oh, I just sat on the sidelines." Because sitting on the sidelines has cost you, and a full disclaimer here, I'm not asking people to go out there and get a second mortgage on their house and get into the market. I'm talking about risk money or trading money that needs to be put to work in the market in certain allotments where you still have cash on the side to deploy. Some people can say, "Hey, I don't have that much, and I'm just trying to basically, work with this what I have." Okay, I understand, but that doesn't mean that you have to take the whole kitty and just throw it into one position and it doesn't work on a Thursday or Friday and you missed out the whole goddamn rally that happened prior to that, and now you're coming in, like, quote unquote, like I say, not in derogatory term, but that's what really happens, as a chaser, and you're going in there and lumping everything, and then Friday, and I'm going to go through this very carefully about what really happened on Friday, so just wait out for this, okay? This is important. And anyway, and then, oh Lord, this is terrible. I can't do it. So my point is very simple here. You're going to keep on following your own method of doing things and making your own excuses why you don't get the trades, long or short, And believe me, we had short trades out there too. We had the UVXY and we had the UVXY calls, which went ballistic. I sold along the way. Of course, there were hedges, but most of the bulky positions that I had were sold pretty much on the ramp up the day prior. I want to remind everyone clearly before the point, and I'm not talking about you guys, but just in general, little voices in your head I'm talking to, not necessarily you guys, okay? Those little demons in the head. Maybe this is directed to them. Is the fact that as a tactical trader, the move that happened prior to the move down and levels which were taken out, sliced out on Friday on quad witching, which generally is a bullish event. But for reasons that I'm going to go through in the next couple of minutes, it wasn't. It had a very little fundamental basis to it, mind you. I'll tell you that right now. This was a very technical monetary issues that were going on the money management standpoint, which caused the unrelentless drop into Friday's close. So just have patience, and I'll go through it. So because the more you understand, the less ignorant you are, and the better you are in containing the emotional fear that just grips people at times, and they just can't do anything. So that's it. From a behavioral standpoint, what I found, as I was saying earlier on, is that I would say 99% of the time that you don't get the monster trades, and many of you don't. I know that. Okay, many of you don't. It's not that you're catching a falling knife or this and that. You don't, because you just don't act. And then when you don't act and you come in the next day or so and you're looking for that quote unquote all clear signal, which the market gives you, and then just swoops and just comes in like a chopping, guillotine, right? Boom. When everything looks technically perfect for a move up, which it did after the Fed, mind you. Okay? When you look at this was a perfect technical slice up, which meant that we would go and test the 2097 on the S&P. But you know what? Right there at the 2076 level, the chopping block, the machines came to work. And the machines came to work on 1217 and 1218 on a technical reversal. So but the bottom line is that 99% of the time, it's not the trades that I produce, and it's not the alerts that I'm giving. Either you don't take the hedges, or you don't participate on these massive turnarounds off the lows. And this was a massive turnaround of the low when the market went from 1992 up to 2077. Right there alone, you could have made your month if you had acted aggressively of these bottoms. As we're getting close to acting aggressively of these bottoms, which we're going to go through on the third stage of this presentation, and you'll take whatever out of it and act accordingly. It's up to you. So when you don't act from here and you try to get in here and everything looks good, and then the reversal happens and then this happens, there is no one to blame but yourself. It's happened to me too. But through my mistakes, and I make lesser mistakes than other people. I make mistakes, no question about it. I sell things a little bit too early at times. I don't follow through towards the end, till the end. But the fact is that that's where you go wrong. You go wrong regardless of what happened last week or the end of last week. You all and the whole investor community and myself to a certain degree, we all go wrong because we don't act on extremely opportune situations, and we are always looking to feel comfortable. Whether you're standing, sitting, or whatever you're doing, or squatting, all right? The bottom line is that you're always wanting to feel a bit comfortable, regardless of what the technicals are, before you want to tap in. So here's a solution, which works for me. Why go in full blast? Why not go in steps, i.e., aka scaling in? So if you go wrong, then you can say, hey, I just went in with one little toe. okay? Or I touched that hot scalding water to see if it was warm enough, okay? Or the pool was, chilly enough whether I should dive in or not, okay? So you just put one toe in. Why go in with everything? These are just, believe me when I tell you one thing. Algos and high frequency trading programs, they will simply exasperate and amplify what is happening in front of you. So when you see a sell-off, they will go in there and cause a bigger sell-off. All of a sudden, the media, the press, the bogus analysts who basically are market strategists who never, who are never really right, come in with all different reasons. Oh, and then of course the dogmatic bears. And this, by the way, happens on the long side too. There are dogmatic bulls and there are dogmatic bears. I'm talking about the recent events here. The majority is bearish. That it showed up on the sentiment polls. It shows up on what the Wall Street strategist numbers are. It's all over. It's pervasive. The fear, the pervasive as it was at the beginning of last year when nobody expected the market to do what it did. Okay, this was supposed to be a calamitous market where we were going to be down 20% for the year. You don't believe it? Go Google it, do your own homework. It's the same feeling right now as we enter 2016. That 2016 is going to be the year of massive, massive pain, as if it's a one-way slide down. So if that's the case, then we should be at zero in the market by December 31st, 2016, and my kid's going to be in college, first semester. Great. So why don't we buy $100,000, $10,000 worth of S&P puts on January 1st and then just go away for the year? Well, I wish it was that easy. My job is to make money. If I knew it was that easy, I would do it. So what I'm getting at is controlling your emotional amygdala. That's a word you should Google. Okay, please. It's a subpart cortex of your brain which controls your emotional capability to do what it does. This is a battle, ladies and gentlemen. And if you don't have the mental fortitude to play in the game and to fight the and to do battle, to fight the war, you will never ever do it. Look, I don't wake up every morning thinking the market's going to be up. I wake up every morning thinking what I'm going to do to protect myself, not just on a defensive way, because everybody is playing defense. Nobody's playing offense. I'm not even playing offense, in the sense that even when I know of these lows that the market is about to make a significant bounce, I'm not going out hog wild as I normally used to. So if I'm not playing full offense, but still doing bigger, going taking positions more aggressive than other people, but I'm not playing real offense, then what do you think the others are doing? They were cowering in this massive, vortex of fear. And then I don't know what. So you get the message. All right. Nobody needs to be a eternal bull, and nobody needs to be a dogmatic bear. But I'll tell you one thing: the frigging fear and apocalyptic talk that I hear across the board makes me, honestly speaking, laugh. It's like one of those Donald Trump laughs. You know what I'm saying? Just a smirky laugh, like, oh God, here we go again. So fix your head. I have to fix mine, and I do it every day, every morning. Obligations that I have to my family, to my good friends, to my members in my Clueless 8 trading community. That's what I think about when I wake up in the morning. Okay? So all of you, please do the same if you want to do this business. If you don't want to do this business, take a walk. All right, let's hit it. So here is one of the key things here that happened. And this really opened my mind. I'm going to walk people through it because they have to understand it. Okay? Articles that I put out there, a lot of people read it. Look, a lot of you are not guys who really understand economics to the fullest degree. Even people who understand economics to the fullest degree can't really understand the stock market, because stock markets is a convoluted way of playing economics. All right. So the point is that, give me a second. So the point is that I just want to get this. That we have to understand what really happened on the background. And this article was really something which opened my eyes. And I knew most of it, but it was interesting to see a write-up. Okay, great. Let's move on. So it says stocks got crushed for the second straight day. We all know that stuff. So here are a couple of things which you have to understand. One of the key things was this. Okay, the quad witching was intense, and it was obviously amplified by what was going on with the front end of the market. They kept on pushing it. So this led to the quad witching really led to one of the highest volume days with a particularly volatile final hour of trading, which we saw in what was likely the last day of the fully staffed desks. Now, this point, I want to make this clear. You hear a lot in the media about fully staffed desks and nobody's around. You know, in the old days, and I worked on Wall Street for enough years to know this, it really doesn't matter. In the old days, yes, desks mattered. The guys on the exchange floor next door to where my office was, okay, it mattered who was there, who was not there, who had a massive hangover, and who was falling over or drinking on the job. It all mattered. Now it's the machines which matter. And you honestly think the machines take a break? To think about that twice, all right? When you're thinking about when they write that last day is a fully staffed desk. Yes, it could be thinner volume, but there's enough stuff going on. Thinner volume doesn't mean that price is not going to move up and down. One of my ex-bosses used to tell me, who the heck cares whether there's volume or not? If you're making money, you're making money. Stock prices are moving up and down. Who cares about the volume? So the second part is obviously, the internal battle, and it's good to know both sides of the story between the bulls on the Wall Street and the eternal bears on the Wall Street, like Henry Blodgett, the man who lied and cheated about his great analyst reports. If you know about Henry Blodgett back in the 1990s with his research reports, and then obviously got banned from Wall Street. But now he's a superstar, because now he can talk outside, and he's got Business Insider, which got bought out. So anyway, he's a smart guy, I'll tell you that. But still, he is extremely negative on the market. It have been for the last 3 years. So net for the last 3 years, he's at a big zero, okay, on his belt. But now he's talking the same things. So you can look all that stuff. This is Tom Lee, who's been steadfastly bullish and has been right. And he's a very smart guy. He used to be JP Morgan. Now he's got his own stuff. Own outfit going, Fundstrat. Tom Lee, he's that very amiable looking Asian American gentleman, with smiley face, but he's one smart cookie, I'll tell you that. Read his stuff. Okay, so this was a chart that he put out showing the actual bull market cycles. I think a very interesting chart to look at as to what might happen. This goes back to 1910. Woo! And honestly speaking, to me, history matters, but not as much, because the reality of the thing is that the world has changed. We are in a new paradigm of monetary fiscal policies, new paradigm of the way things are traded in the market with high frequency trading programs, algorithmic programs that run the market. And at the current moment, the complete absence of the retail investor in the market on a direct basis, and all kinds of good stuff. And then, of course, the global involvement with so many players. If you study game theory, you'll know it all depends on how many players are sitting on the table, just like a poker table. The larger number of players, you got to act accordingly, right? So it's the same thing. So those things are obviously not taken into account when you're looking back at the history of financial markets in this period. So you got to put somewhere around here when computers entered the market in a massive way. So now what does that mean? It means that any type of movement in the market is going to be severely amplified. What would normally take 3 weeks, 4 weeks, a month, 2 months, now happens in 1 hour, 2 hours, 2 days. Weeks don't matter anymore, because if we're going to fall, they make things fall within literally 6-7 hours or within 2 trading days. Or if they want to take things up, and as if we don't know that, we see that every single time, right? They'll take things up, and we're like sitting there going, "Oh my God, why didn't I get in?" Like, hands down. And then as it keeps on moving higher, what does it go to the head? Oh, I missed it. Oh, I missed it. And the next leg goes up, boom. And you're like, oh crap, man, I can't do this again. And then guess what? The market comes back to the same level. And what's the first thing in your voice? The little voice, that little demon in your head goes, oh, I can't buy this. Market's going lower. Then the market's going to take boom, a 300-point up day within the next, let's say, who knows, 24, 48 hours going into the Christmas break. And it'll be like, oh man, so enough of that. Let's try to be as factual as possible and do what we need to do. Now, this is really important. And I'm not going to get into the nitty-gritty of it because it takes a little bit of understanding. Friday was the second day of the Fed's reverse repo operation, with the new quarter-point floor in place following Wednesday's policy change. That's simple English. The Fed raised rates. So the Fed funds rate is now at a 0.25%, not at zero anymore. The amount of treasuries repoed or lent out overnight in exchange for cash. Okay, that's how the Fed conducts open market operations. When they say, oh, the Fed's doing QE, does anyone even understand how the heck Fed does QE? I'm sure a lot of you do. You're very smart people. But the ones who don't, look it up. What does the Fed do? Just come into your local Stop and Shop and give out free money? I'd love that. But no, the Fed goes in there and conducts certain open market operations in the form of infusing or injecting money, cash, dineros, okay, into the economy by buying treasuries and government treasuries, government bonds, as well as mortgage bonds. By soaking them up or buying them in the open market, which is the open market that's open to all of us, when you're buying something, what do? You go to a store, you want to buy a bottle of wine. So you give the guy $20, you give the guy $30 and say, hey, I want that bottle of Cabernet. So you buy it. So he gets your money and you get a bottle of wine. So that's what the Fed does. He gives you a piece of paper saying, okay, this is your 5-year bond, this is your 10-year bond, this is your 30-year bond. And in the meantime, you give the Fed money to buy it. So now that the Fed's raised rates 0.25 percentage point, what are banks doing? They're soaking up that paper because now instead of getting zero, they're getting 0.25 percentage point. So think about it very simply. Money is going from the banks, okay, in the Fed repo operations to the Fed okay, it's going like that to the Fed, and in return, you're getting a 0.25 percentage point paper. And in this day and age with low interest rates, that's decent. That's decent money. Okay, so there's a flow of money out of the system into the Fed. So when the Fed got that repo, if you look at this, lent out overnight in exchange for cash, and these are overnight transactions that happen all the time. Okay, overnight lending. Total 143 billion, up from 105 billion. That means it was 38 billion more that went into the Fed from the banks as overnight repos, because the banks can make 0.25 percentage on their money, 0.25 percentage point on their money. So the current amount of repos carried out is more or less what the Fed desk has seen. The amount is expected to rise as investors see marginally higher rates reflected in money market funds. Remember, when the banks do, listen to this carefully, when you put money in the bank, who pays you that interest rate? You think it just falls from the sky and just, no. The banks have to basically, the banks do, in order to keep a certain amount of capital in the bank, they do overnight purchases from it's called the overnight transactions, repos from the Fed. And that money market fund right now is going up to about a quarter percentage point if you're lucky, because banks are not that keen on raising interest rates. I'll tell you that right now. So when you look at your deposit, you think, oh, I'm going to make more money on those millions that I have in the bank. Well, you're not. But your overall rate has slightly crept up to what the interest rates the banks are going to give you, right? So the banks basically have now, all right, in money market funds, for example, thus making these attractive vehicles to park their money instead of short-term treasury bills or cash. So another thing is that operations could climb to 1 trillion daily in the coming months, with the Fed saying in a statement it has upwards of 2 trillion available for this operation. So what it means in simple English, that this was the first time in a long time that the overnight repos actually benefited the banks. So money soaked out of there. So the banks, instead of going out there and putting money into the market, at least for Friday, what they did was they put more money into the Fed repo operation. So that caused a selling pressure in the market, because less money was going in the stock market on that particular day. On the Friday was the second day of the Fed's repo. Interesting, huh? Because the first day of the move down in the market was Thursday, and the second day was Friday. So both days were the Fed repo operations. Interesting. All right, and both days the markets were down. So different, these are fairly very high level stuff that's happening underneath, pressure in the markets. It doesn't have to do a fundamental basis on stocks and stuff. I'm not saying for this fundamental basis some of the stocks going down, of course, but I'm talking just in general. Crude oil, big factor. I mean, it just can't hold a bid even if it tried. I mean, look at the fake out, doing nice, and then bang. Another reason for the drop is the Canadian market. The Canadian market getting walloped. The crude oil continues to make new lows, and there are Canadians here in this group. You guys will know. We could go and actually, we should just, go shopping in Canada, except they tax us so hard out there, and the prices are much higher out there. Otherwise, it's a great exchange rate. It's $1.40 against the US dollar. So for every US dollar, and my other part of my family, they my wife's sister and stuff, they're up in Canada. She's married to a great Canadian guy, and the bottom line is that it's that had the factor. So oil's just crude oil. Now, so the quad witching coupled with the Fed repo actions, in my opinion, put some heavy duty pressure on what was going on in the markets, and this piece opens it up. Then you have then you had the rig count, right? So the U.S. oil rig count actually rose by 17. So that was construed as somewhat negative because rig count should be going down. But there's a point at the number of rigs out there can be taken out of business, out of operation, right? Because what are you going to do? The Exxons, the EO, all the big ones, not everyone's coming to my head right now. Halliburton's and stuff. What, they're going to just take out all the rigs? I mean, we're going to be renting rigs from Mexico to take out oil. So anyway, so that's that was obviously another factor too. Anyway, so this article, when you get a chance, read it. It's very interesting. This chart is also another one that you should print and keep it, because it's worth keeping an eye on, just in case you intend to make money in the markets over the coming years and invest in the market for your children and for your family. So this is very important. So now we're going to get into technicals. So there were many factors that roiled the market, and I'll tell you one thing, that and I've used this word many times before, and every time I've used it, we have had a short-term bounce, is the velocity and the ferocity and the aggressiveness of the selling. I could clearly see was coming out of some massive movements from on the part of the machines, rather than actual liquidations from mutual funds. These are machine-driven selling. Also keep in mind that we're at this time of the year where we're going ahead and adjusting a lot of portfolios. So it's tax loss selling, you name it, all kinds of stuff. Because there were not a lot, but a whole bunch of stuff that were quite green on the screen out of the blue. I mean, why was something like a JD up? Why was something like GoPro going berserk? Why was something like Red Hat still holding up? Which, by the way, was a great winner. And thank you, Sienna, for mentioning that to me. I put it out there and sold it right at the open, and the comment and stuff were sold some the prior night before. I mean, people who took that trade again would have been fantastic. And I just took small bets, and it worked out beautifully. And I didn't chase it the next morning. I didn't tell people, go out there and buy Red Hat. So it's, again, I would say almost all of you missed it, other than maybe one or two of you. So who's to blame? So bottom line is there was a bunch of greens that were on screen, small ones, but that's because maybe they were not the ones. There's another little stock that's in the long-term portfolio, which I am to blame, and I do apologize for that. But I will certainly be getting that up and running, which is Calisara Biosciences, which was up 5.5%. There were bits and pockets of things. So let's take a technicals here for a second here. So here we are, S&P 500 right in front of you. Pure lines. Let's try to keep let's try to stay as unemotional as possible. Let's draw these lines. Let's see what we can do going forward. Okay, let's do that together. Let's be robotic. So here's a wide channel. You can see that we are at the bottom of the channel. There is one other move here, which is in the 1989 range. We closed at 2005. So there's one move here at 1989 range, which correlates with a bull flag consolidation on October 14th. It's always the middle of the month. Oh boy, come on. I apologize for this. Hold on. Daily. Okay, here we go. All right. And you can see that right there. Okay, the microphone static guy is back. Can you please fix that? Somebody's microphone is just leaking again. Thank you. Okay. I think they're tucking the microphone under their pillow or something. All right, good job. All right, so we had so this level here, and this was the big pivotal move on the 14th. On the 14th, Fed day move, right? No, Fed was what? Fed was the 15th. I'm losing track here. Let me check on my side to get this thing right here. Bear with me. Just want to get these things right. Okay, let's see. Yes, Fed was the 16th. Sorry, so Fed was the 16th. It was the move on the 14th, and then of course the Fed was the 15th, right there. Sorry, the 16th, right there. So this was the move prior, on the 14th, which was the Monday, the big move Monday. After the big move. Oh, so let's put this in perspective here. A week ago, which just seems an eternity to me, at least. I don't know what to you guys too. I'm sure it's this was the Friday that nobody wanted to even come close to the market. Look back on what we were doing. We were starting to scale in because it was reaching those climactic levels, both on the daily stochastics, not to mention that we are reaching the bottom end of this channel. Okay. And then on Monday, this was the Monday, we slipped lower. The screams of angst and the silence in the room, all natural tendencies of human beings. Nothing wrong with that. Please, can you mute your microphone, whoever this is? Hello? Can everyone just can everyone just mute their microphones? Hello? Can everyone just mute their microphones, please? For God's sakes, I'm being serious here. Mute your microphone. Please have some respect from other people. Because I can mute everyone from my end, but that static is going to remain. It's going to make it difficult for other people to go through this. Just simple courtesy, please. All right. Thank you. So bottom line is that we had that massive reversal on a Monday. Is it possible this Monday that we slip further down towards the same levels and then have a powerful reversal on a technical basis? Absolutely. And here are the reasons why. I'm showing you a daily chart. Then I'm going to move on to the closer end charts to see it. Just technical stuff, all right? None of the emotional garbage that we have to, that we have to fight in our heads. Let's keep that aside. Let's keep that for our dinner table talk, that the world is about to get finished and it's such a terrible world because ISIS is demolishing our democracy and all that stuff. Let's talk about technicals. So we have a lower Bollinger touch here at 1999. You can see that. You have an acceleration band here at 2008.74. So the lower Bollinger touch can, remember, when things hit a certain level, there's an overshoot. Just like life, okay? You go boom, you get hit, it's like an overshoot. So the overshoot is what brought this down. Anytime you see something completely out of its trading band, and in this case on the daily side, it is a massive monumental buy. Short term, just the way this was a short term buy. It engaged the 34-day moving average, which I talked about. Go listen to my video cast. The 50 and the 34-day moving average. It might have had an overshoot. It didn't. But once you hit that 34 and the 50, now that the lines are starting to curl down, that is your point of exit, period, done. That doesn't mean you got to go in there wholeheartedly and short, but put out some hedges. I always tell people to do that. It's not that hard. The UVXY calls when I was calling for the December 28th, December 3, this week's hedges were at $1.80, $1.90. They went to 2 and change. They weren't moving. They were boring. Believe me, they were. Most that went through was 210. Left them out there. They went to $10. Wait, did you guys participate in it? I put it out there. Exactly. So this is the point I'm trying to make here. When you don't participate in something, even on the short side, then don't blame your portfolio or the market or me for the long side. It's simple. So saying all that is, and I'm not saying you have to hold it till 10. You don't need to get 900%. You told 900%, your wife would basically buy you a crown and think you're some kind of friggin' genius. How about a double? How about a triple? Your wife or your significant other, your spouses, your husbands actually love it, right? So it's the same thing. Bottom line is, at this point, technical lows here. Very clear to see. So I'm going to get my drawing tool and just show it to people, and then you guys take it and run with it. Because the key thing is that my work is my work, right? I'm showing you what's going on a factual basis. After that, you decide what you want to do with it and how you want to play with it. That's your job. My job is not to run your book. And I've said this and I keep on saying it again and again and again. My job is not to time every trade and tell you, okay, buy here, buy there. I'll show you what the entry points are, what I'm telling you exactly what I think are the exit points, what will happen over the next 24 to 48 hours into a beautiful Christmas Eve and then Christmas, okay? I'm just showing you that. What happens with the markets and stuff? You adapt. I'm there constantly to show the different movements that are going on, and what you do with it is your business. And if you play that way, you'll win. Don't rely on every little tweet that comes out because it's not going to help you. You got to make your mind as to, okay, I want to, if he showed this roadmap and I think that's what, that I'm playing it. So if I'm up a bit, you decide where you want to take your profits or not. That's the goal of this webinar. Okay. So here we have a significant low and right there. Then you have the lower end, the Bollinger and acceleration bands and all that good stuff. Is it possible that we completely fall out of these bands and just straight line down, go down here? There's a minor gap here, by the way, at around 1950. No, it's not possible. No, it's not possible, because that is too big a move to happen right away. Is it possible that the market goes there? Absolutely. I believe the market can go to 1860 and create a massive a triple bottom, or a collapse of the triple bottom and go lower. I'm talking about short term, ladies and gentlemen, because that's what you're concerned with right now. So saying all that, anytime you see a massive move out of the Bollingers or the acceleration bands, means things are completely dislocated. Remember, mean reversion always happens, will always happen. Mean reversion. So when you're moving off, and it's simple, I'm going to keep on drumming this in. When you're moving off, this is your highway. Okay, these are your highways. The 34-day, the 50-day, whatever moving average you're using. I use this because they seem to work most effectively. Then you have your 5-day moving average, the yellow one. It completely left the mark, right? Boom, off the Friday moving average. So the standard deviation from the highway of the 34 50-day moving average to where we landed up is almost -2. It's the same length that we travel here. It's the same length almost. Actually, bigger than that. No, they're almost the same length. So what does that mean? That means there's going to be a mean reversion over the next 24 to 48 hours. Now, mean reversion doesn't mean that we're going to go completely berserk and go up to 2061 and have a 55-point move on the S&P 500s that correlates to about roughly 350 to 385 points on the Dow to take us back to about 17,500 on the Dow. I hope everyone understands what I'm talking about. A move from here up to test the moving averages at 34 and 50-day moving averages is a roughly about a 350-point move on the Dow. That brings us up to 17,500 or so on the Dow Jones Industrial Average. I'm just showing you the probabilities of what might happen. Is it possible? Absolutely. Nobody thought it was possible here. Just one Friday ago, not talking about this Friday, but the past Friday. So why can't it happen this time? The world changed? No, nothing changed. In fact, the Fed finally did what they should have done a long time ago, which is raise to start to normalize rates. They're in fact many positive. Oil's cheaper. People are shit scared. Sorry about my French. Is actually the S word a French word? I'm just kidding. So the bottom line is that, so why not? So on a short-term basis, just showing you some bounce levels, what can happen. However, these Bollingers are starting to turn down. So that's bearish, yes. Medium term, intermediate term, bearish. No question about it. Because these lines, these moving averages are starting to curl down. Not as much as, you know, as that some of these commentators would like to tell you, but they are starting to curl down. And if we do have a crossover, and this is key for everyone to understand, and please have your own chart systems to figure this out. Thinkorswim is one of the best. The other ones, the Algo HFT charts, are terrific, but these ones show you the trend better. So if this line crosses down over like this, we have a negative crossover of the 50 and the 34-day moving average, then this is the case. That's a see you later, bye-bye story. Does that mean we're just going to do this move? I don't think so. But what do I know? This was also propagated by a massive capitulation of a large number of hedge fund type critters, okay, blowing up. Is it possible that we can do this move down? Yeah, we can. We can. Here, the Bollingers and the Bollingers and the were left in the dust. It's just the market, the standard deviation from the highway, which is the 34 and the 50-day moving average, was almost -7. Best buying opportunity ever get in a long time. Did you buy these lows? We did. I'm not sure some of you, some of you participated, no question about it. Monstrous move up within the next 48 hours. Remember, the best money is made within 24 to 48 hours of a move down. Just the way it happened here, 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 the next 2 days. But you got to catch it. That's why I'm saying that if you, within the limited amount of money you're ready to deploy in the market, you have to be the most aggressive of these tactical low levels. That's what I mean by saying you got to be aggressive at the lows. And it's the scariest. But that's just the way it is. That's just the way it is. I kept on buying those S&P calls. They're like bang, bang, bang. Little bits at a time. But what does it matter? What matters is what happens over the next 24 to 48 hours when I do what I need to do. While the chasers come back in again and get slapped. That's it. That's the way it goes. All right. So the bottom line is that at this point, I'm not going into the all that long-term forecasts as I'm showing you what's happening on the low end. This is getting severely oversold, and this is again, it hasn't turned yet, but by the time it turns, this happens. This type of candle happens. It's crazy to buy into this type. I mean, it just feels terrible. Oh my God, the market's up 150, 200, 300, and you're just like, you're sitting there like a moron. You don't buy here, you don't buy here, and then you decide to buy here. Well, these turns happen when the reversal happens here on the stochastics, right? You can see that. Can everyone see this? Can I get a response? Can everyone see this?
Yes.
Okay, good. Because it's important that everyone have a visual connection with what's going on. So, so bottom line is that we're getting there. And then this is something also very interesting that I noticed. Okay, and I'm going to make this line this a little bit bigger. When I looked at the McClellan, and I didn't get that much time to sit there and study a lot of charts this weekend. I had some family obligations. I noticed this. I sat down. When we went down here to this level, which is not too far from where we are, what 1990 on the S&P, and we closed at 2005. And let's say we go to back to 1990, that's 15 points, right? Can somebody tell me very quickly? Let's see how brains fast work. What's 15 S&P points on the Dow? Quick, please. Because without quickness, you will not survive this battle. Can somebody type it in? Can somebody tell me what's 15 S&P points on the Dow Jones? I'm really disappointed. I'm serious. I really am disappointed. I'm still not getting an answer. Nobody's typing it in. Nobody's telling me what's 15 S&P points correlated with the Dow. How many points on the Dow is if we go to 1990 tomorrow morning on the S&P 500? What's the drop on the Dow Jones Industrial Average? Is anyone there, or should I just shut down this webinar? Okay, can somebody stand up and be a real man or woman and say, hey, I don't know the answer? I'm really, this is incredible. Is anyone there? Can anyone hear me? Hello?
Yes.
Okay, so I asked a question. If you don't know the answer, ask me. I mean, seriously, I'm like, look, I'm trying to help you guys. You don't know the simplest answer to what I just asked a simple question. Guys, this is the real deal. I mean, what am I teaching? Kindergarten? You guys are traders. You guys are making money off my recommendation, right, left, and center, and sometimes losing money, and you don't know what I'm asking you a simple question. Don't get me frustrated because that's ridiculous. 15 S&P points down. Let's say we open down 15 S&P points tomorrow morning. What's that on the Dow Jones Industrial Average? If you don't know the answer, say, hey, I don't know the answer, but don't keep this frigging webinar on silence.
120.
Around 20.
Okay, so what took so long to answer that?
I think your message board is not working.
Who cares if my message board works or not? I'm listening. Are you listening to him? I'm not using my message board.
Okay. Anyway, we typed it inside.
Oh, I see what you're saying. My message board's not working. Okay, now I look like a total idiot. You're absolutely correct. So Roger Gandhi said 105. We're typing in. That's my buddy. Okay, I see it. Okay, now I look like an idiot. So why couldn't somebody come and tell me that scroll down your message board? This is what happens, and I do apologize. Okay? And believe me, I wouldn't be this passionate if I don't care about you guys, all right? So I do apologize for that as a grown adult. Is this little chat box that's on the right on one of my screens is so small that I had to scroll down to see what do you call scroll down to see what people are putting out there. Okay, done. End of story. It's all good. This is what happens at market bottoms. All right, Tats. With that voice, it must be Tats, right?
Yep.
There you go, Mom. All right. Thanks, buddy. Apologize about that. Okay. Yeah, Nader knows that. Fokusan. From the great white north. All right, so listen. So all right, good. So if we drop another 100 points at the open tomorrow, then we engage these levels that we're talking about. Okay, so the bottom line is that that'll certainly bring us way out of these bands, and I believe that should set us up for a nice little move higher. So 100 points or so, or 120 points pull back off the top tomorrow, as we get into the trading day, would actually, in my opinion, be a good one. If we continue down, that means something like this is happening, where we're going to completely leave the moving at the Bollingers and acceleration bands in the dust, and that's a complete fallout. It is also a possibility, a minor possibility, but it could be. I don't know yet. So the different ways to look at it. This channel and these things will support the market. A possible move down right here, okay, right here to 1990, 1991 would be a solid move. In this case, we would be looking at this, okay, a possible move up. Again, maximum move is retest of the 34 and the 50. I do not expect the market to break over 34 and the 50 this week. If it does, the next would be the top of the channel at 2096. That's it. But I think that once we get up here towards this slightly downward trending 34 and the 50, we fail again. And that sets us up for a nice big fat fall. All right. So that's my theory. So playing this tradable bounce here that's coming out, that I think is getting set up for now, based on all the different things that we talked about earlier. All right. Now, let's take a look at the McClellan oscillator. And I found this to be interesting. We got a big thump these last 2 days, pretty big. The McClellan oscillator only went down to -105. So in effect, it's creating somewhat of a positive divergence. Somewhat of a positive divergence. Similar to what happened here. The McClellan oscillator hit the McClellan oscillator, this is the crash of, so this is key, okay? So listen to this, guys. So this was the crash of August 24th. Horrific, right? The flash crash and the whole works. Great buying opportunity, but still, catching a serious falling dagger, not even a knife. So the bottom line is it made a massive move up, quite similar to this actually, and the market went berserk. We had a nice little pullback here, which was pretty scary too, I remember, on the third day. Just heavy, intense volatility. Same stuff that we're seeing here. Guess what happened to the McClellan oscillator? The McClellan oscillator came down just like this, a little bit. So we basically gave back almost more than half of this big reversal. All right. But the McClellan oscillator only created a small bull flag. Guess what it's doing this time? Same thing. We have given back almost everything from Monday's ramp up. It's pattern symmetry, right? Look at this. 3 marching soldiers. We got 2 fat marching, and these are fat soldiers, right? Marching down. Look at the McClellan oscillator. Shouldn't it be down here if it was a direct correlation? So this is known in technical parlance as a positive divergence. In other words, the prices came down to previous low levels, but when you look at the actual internals on the market and the actual oscillator, it didn't get there. That's a positive divergence, whichever way you slice it or dice it. Is that clear to everyone? So we didn't get, we didn't get down here. We created a small, we had a pullback. We went from 0 to minus 105. Remember, once the McClellan oscillator gets up towards these levels, it generally connotates a, a top. So once it has a top, it creates a small, flag. Now here is another thing you got to learn. From October all the way through November, the markets ramped. The McClellan oscillator kept on going down. That was a negative divergence. And then it hit rock bottom. We had that big move down. It hit rock bottom again, and it moved from here. So that was a negative divergence. So here we are starting to see a somewhat of a positive divergence on the McClellan oscillator. These things, just over the years, over many years, I should say, both from a swing trade standpoint, have worked terribly well. So like they say, like I like to make it simple, that a day or two, or let's say a day in this case, of sacrifice could yield a significant amount of profits going into the first couple of days of next week. Let's talk about some seasonal factor. Do I see another 500-point down day before Christmas after everything that's happened this year? The US public, the US consumer, has bought tons, billions and billions of dollars of worth of goods from the online retailers, causing a pushback on physical retailers. We know that, right? Amazon has just soared. Amazon's, I mean, I don't know what their numbers are going to be for next quarter. I'm telling you, it's just going to be huge. So Amazon literally has dominated the full retail landscape by sucking up more than 60% of the holiday sales that have been out there. So the American consumer also has been shaken tremendously by these terrorist incidents that have repeatedly happened on U.S. soil, and the latest one being San Bernardino. So my point is, from an emotional standpoint, there's always the invisible hand of whoever may be, okay? Whether it be the Fed or whether it be, whatever other, it's called the plunge protection team, the PPT, the plunge protection team. Do you think they're going to let another 600-point drop right before Christmas? I think it's a low probability trade, because we've already dropped quite a bit. We dropped 500 points or more just in the matter of 2 days. So the chances of us coming down another 600 points, which means that that's another 500 points. That means coming down to that 1950 level or so, or less than that, less than that. Immediately, I think is a low probability trade, because I've studied so many different factors in my trading. In some cases, moon cycles too, believe me, okay? And some of you have been with me know that they've been pretty accurate. But just from a standpoint of where we are right now, the last leg of the Santa rally, the first leg of the Santa rally was this. Okay, this was the first leg of the Santa rally. Then Santa basically got hit by a drive-by, right? So he was joking around and saying, what was Santa doing in some bad parts of town, like south side of Chicago, right? So the bottom line is that that you get it. So this that at this point, the dragon bullish up towards either the breakdown level, this line is key. This was the previous support level of 2040, and possibly an overshoot to 2060. I think is the most we can expect. And if we and of course, keep in mind that on a daily basis, if you look at this yellow line here, which I track as the trader's line, I call it, sort of people use the 8-day moving average. This is a 5-day moving average. this could be also the possibly a resistance, because this line has to move up, in order to validate a move up towards towards these moving averages. But right now it's kind of flat. I find it interesting that after this type of heavy duty aggressive selling, that the 5-day moving average is still kind of flat. It's kind of flat to down. I mean, it should have plunged. The 5-day moving average should have just plunged like that. Yes? Yes. It didn't. It stayed kind of flat. So all these things you have to notice if you're a technical trader on what's going on that front. So this I find to be very interesting, and not to harp on it. Now let's take a look at a closer view on what's going on. And before I move into that, I'm going to stop myself and just as important question, everything that I've talked so far on all the different aspects, behavioral, economic, as well as this technical stuff, is it making some sense?
Yes.
Okay, and if it's not making sense, then feel free to ask, because this is an open forum and no one's Okay, good. Let me just now the other thing that from a broader standpoint, thank you always. The other thing from a standpoint of well, let me get this line here. If somebody's like an Uber bull, right, and they said, you know what, all this garbage, this market's going to, the Dow's going to 19,000. You guys are all idiots. There are bulls out there like that. Believe me. All right. They'll make this particular argument that this is basically a large cup. This, ladies and gentlemen, is a handle. So what's the big deal? They'll tell you that. I've shown all the bearish and bullish things that I can see on a short-term basis. But if you look at this, this is a large cup and a handle. What does the cup and a handle do? It breaks out. Very seldom does a cup and handle break down. It happens, absolutely happens. In that case, it's not a handle. The handle gets broken. That means you bought some cheap Chinese counterfeits out there when you should have bought expensive Lenox China or something more expensive than that. So bottom line is, it's a cup and handle. I don't buy that. I'm just looking at it. I'm just showing you that that's the case right now, as it stands. So when you put things in perspective, you start to think things differently. I'm not in this bullish camp, just so you know that. All right. So just passing it on. Let's move on to some shorter term pictures. And I'm going to bring in the futures market. Okay, how about that? Which is more relevant because that's where the gamblers really lie, in the futures markets. Okay, ladies and gentlemen, let's go in there. And by the way, before I go forward, I'd like to thank everyone who's attending, because I think what we are talking about here, what I'm trying to explain in my feeble way, is going to help everyone. So when they enter the market tomorrow morning, they're ready to do what they need to do. They're not going to be right on every single trade, but at least they'll know what they're seeing. And the rest of the people who didn't attend it or don't bother, or I'm sure some of them will be listening to on the recorded thing. It's different on the recorded thing, because then you don't get to see me getting all like crazy passionate because I'm not reading the chat box, right? But the point is that it's important. It's important for me. It's important for all of you guys. Because when I do these things with you, I also see things sometimes that I'm not seeing myself. So you guys are definitely doing a great job of attending tonight. Thank you. So saying all that, let's take a look at the E-minis here, right? So here we have the downtrend line, the uptrend line here, joining two climactic lows, one being August 24th, the flash crash, where the Dow went down 1,200 points. I mean, it was just like, whoa, right? Went to two flash crashes. So I'm a total, I should get some medal for this. I went through the May one in 2010, and then this one. So there you go. All right, 5 years later. So and both times I made some pretty decent money. So that says something. So here we go. Then we had a higher low, and that was August 24th, and the next one's intersecting at around 1960. Okay, so we're going to test this one too, in my opinion. Okay, I think we will test this one. Will it happen this week? I don't know, but just be prepared for it. So at this point, these are the E-minis. I've noticed one thing here: the expanding Bollinger and acceleration band, because of the velocity and the ferocity and the aggressiveness of the machines, you are getting to see a big expansion. This thing is broadening out. Look at these. I mean, normally the band is the width of the band, let's say, is this wide, right? Look at the bandwidth here. Just stretching down. I mean, it's just bringing down the lower end. Bolts will tell you this is a coil spring, because bands, the Bollinger acceleration bands, don't have this wide a width on a technical basis. So you need to basically compress it and get this band narrowed, like it narrows here. Like these are volatility channels too, right? But look at the bands. The width of the band is sorry. Let me get this. So this is the width of the band. Look at the width of the band now. Whoa. We're talking about how many points? We're talking about 1981. I'm just taking a rough figure. And up there is 2136. 155 S&P points multiplied by roughly 7. So you're talking about 1,050 to 1,085 Dow points. Wow. Talk about volatility. When bands get that wide and stretch to the downside like it did here, for example, look at the width of the band down here, right? You start to get a big outsized move to revert back towards the mean. I repeat again, when Bollingers and acceleration bands and trading ranges get completely out of whack, you have to see where you are in context of those bands or trading ranges. So in the context of this trading range, we are on the lower end of the scale. So bullish, bearish, let's throw it out the window. Let's look at it from a standpoint of pure physics. Okay, just rubber band stretching. So the rubber band's being stretched real wide here. So reversion to the mean tells me that the probability of a snapback is a bit more likely in the short term, keyword short term, than a probability of this band completely stretching further down. It is still a probability. So it's still in the cards, ladies and gentlemen, okay? So I'm not writing it out. If we fall out of this band and just do this, for whatever reason, if Santa is not a drive-by shooting, they actually got Santa, okay? Then we're going to fall lower. But between what I've seen repeatedly, that when you're stretching this as a coil spring, the coil spring says we're going to go a little bit higher. So that brings us to the same levels that we're talking about. This is actually looking at the futures chart, not even looking at anything else. So that's important for everyone to keep in mind. Let's take a look at the internals here. So the same thing here. We could slip here, 1982. Let's say we had this big block of selling coming out of Europe or Asia. Then we engaged 1950. Can happen. All right, can happen. The other thing that I talked about on this snapback, where I said that I noticed one thing, and if you listen to my video cast, you'll see that. Oh, and talking about sentiment, I'll tell you something, because I know how the mind works. Believe me, I tell you. Both in my life, and I've studied enough people, dealt with enough clients to know that in my life, is we had 49 views on the market volatility monthly quad witching options expiration. The general, this is on the YouTube channel, on the Clueless 8 YouTube channel. That was a pretty fantastic video cast too, okay? Overall, just my stuff. And guess what? We had only 49 views. The average views are 100 to 130. What does that tell you about sentiment? People are just, they're like, forget it. Clue knows his stuff and stuff, but this market, forget it. That is a sign of despair. All right, I'm in it. 49 views. I'm looking at it because I get all the metrics, obviously, on the back end. 49 views. And you're telling me people are really excited about the market? No, they just won't touch it. They're just sick. It's all right. Points of despair are good opportune points to have tradable bottoms. Keyword, tradable bottom. That's it. Now, saying all that, let's take a look at the here's the thing. This line here that's put in there, it's open interest. So the open interest on E-mini contracts reached a low on this drop here. Reached a low. In other words, they just got blasted out. The open interest came down. It's like on contracts on the okay, on E-minis. Open interest on the E-minis here, they actually didn't even budge. Normally during some pretty what do you call, sharp moves down, you get these things down. So it's not really a very reliable indicator, because open interest can mean both long and short, right? So we don't know exactly. So the bottom line is that what we saw here is we still, this was options expiration, obviously, these two numbers. One of the things I did notice, which is key, you have to always look at the volume. When you're looking at E-minis, and this thing I really need to basically have everyone one day just devote everything to or reading the futures charts and stuff, is you look at the volumes. These two volumes were exactly equal. There were 2.1 million contracts. That's it. You see these two bars equal. If we were just completely going to go berserk, don't you think we could have had a spike of this magnitude? Well, this was excessive, 5.3 million, or even as high as 2.84. It was even less than the contracts that were bought on the call side, which is 2.7 million. So this was exactly equal to these two bars the preceding 3 days, right? Sorry, 2 days. So what it simply means is that somebody, and this is a theory that I can't validate this theory, but I want you guys to know it. The markets always have equal and opposite effects, because every time that the market makes a sharp move up, and this was a sharp move up, there's somebody else on the other side, in this case market makers in the form of electronic market makers, as well as institutional market makers, who need to make their books whole. What does that mean? When you buy something, let's say you bought 10 contracts, or you bought 100 shares or 500 shares of whatever the case may be, of a particular stock. Let's pick Amazon. So let's say you bought 100 shares of Amazon to trade it. And somebody out there is short 100 shares of Amazon because it sold it to you. That's the market maker, correct? So in an electronic market, it is basically the algos and the HFT who are doing that. So the bottom line is that those electronic trading desks needed to get whole. There was $671 billion worth of short interest, apparently. That was notional interest. And I put that article out there that needed to be covered into this quad witching. Is it possible that they manipulated the market to go down so they could basically get the heck out of Dodge even? Because after all, those hedges were put in place down here. In other words, when we crashed here, there was a significant amount of puts that were bought by institutions, that this was it. This was the big one. This was the 20% move down in the market, which never materialized. So they lost money, because we never went lower than 1831 on the E-minis. So listen to this carefully. It's true. That's how these desks work. So there was a huge amount of puts that were basically, maybe some of them covered here. So the best they could do was they managed to take out, they lost money, because if you shorted at 1850 and you covered at 1998, you know what your losses are. So is it possible that $670 billion worth of E-mini contracts, which were on the short side, needed to get some of their money back? I'm sure that the guys who shorted here didn't just sit around. They probably covered a little bit here. They probably covered a little bit here. You know what I'm saying? Probably they shorted up here a little bit to manage their books. That's dollar cost averaging. Remember? The dollar cost averaging on the short side, you short something here at 10 and it goes against you, and it's 5. So they went ahead, probably shorted a little bit more at 5. What's your cost basis now? Now your cost basis is 5. Right? So by the time it came down here, you were almost made whole. It's possible. There's a lot of stuff out there that me and you don't know. Force is bigger than us. So what do the commentators and stuff do? They start to make up all these cockable stories about why the market's doing what they're doing. But it could be just a pure technical reason what happens, because the institutions who are short the market or long the market, they do stuff which we don't even know about. Now let me show you one other thing here, and I'm going to see if this works. The move from here, I'm doing a Fibonacci retracement, and this is very interesting. Somebody who people who have followed me, they know about the 50% Fibonacci retracement rule, right? It is a rule, doesn't mean it has to be followed all the time, just like every other rule in life. But generally speaking, you get a 50% retracement of any large move in the market, or any stock for that matter. And it does happen. I've seen it happen way too many times. So it's a pretty reliable, tradable floor. So when the highs in the market, 2134. Lows of the market 1831, and do the fibs on your own, and you're going to see so many times on longer term pictures where stocks have given back 50% of their moves, sometimes over months, sometimes over years, and that's the floor, and then they move from there. Okay, so if this is the case, the 50% retracement is at 1983, roughly, about right there. Roughly, we know what we talked about, lower end of this acceleration band, give or take there. Interesting. Is it funny that the market hit a 50% retracement right here and had a significant bounce? There you go. Is it possible that that we hit a 50% retracement here and have a significant move of this magnitude? Absolutely. Is it not right that we had a 50% retracement right here and went berserk? Is it also not correct that from the bottom we hit 50% retracement? Here's a 50% retracement. Okay, multiple times and failed? That's from the downside, right? So is it possible that we hit a 50% retracement and have a tradable bounce? Keyword, tradable bounce. Yes. It's another way of looking at it. All right, let me show you. This is just reading the tea leaves. All right, so that's it. I like this. I like the fact that we're going to smash down below the RSI and we are below the 20 line. You know, the simple 2080 theory. And you go to over 2080, you know, you sell, you know, the RSI players. So this is good. You can see that. Is it possible it goes a little bit lower? Sure. You can't go anywhere below zero, right? That's exactly what happens. Every time you get to these levels, every time you get a sizable bounce, a tradable bounce. Good. Now, let's take a quick look at the McClellan oscillator on the E-minis, and you will see the same story that I showed you on the S&P 500. That is this. Okay, we have a positive divergence. It's almost like a bull flag. Saying all that, all these, if you look at trend lines, like they say, there's so many different ways to skin a cat, right? Ways to skin a cat. So it's just different showing. Trend line is engaged at 1957, 58 on the E-minis. And this is where we are right now. So let's take a quick look on the hourly, what can happen. This is what's happening behind you, by the way. The E-minis are up about 6 points right now. And let's take this line out. And this is what matters to us on having a jolly old Christmas, or having the American public completely demoralized as if ISIS hit the stock market and we're down 1,000 points, you know, before Christmas Eve, which is not a good thing to have, sitting around the dinner table, Christmas, you know, having a festive dinner and saying, oh, how's the market? Well, the market sucks because it's just down 1,000 points. Every time I get in the market, when I start to feel a little bit good about the market, oh boy, it's just terrible. It must be Obama, right? Blame him for everything. So the bottom line is that let's do this. That's good enough. All right. So these are the lines that we're engaging. We are seeing a real falling wedge develop. And I do have to commend Surinodes for their revamped website. Fantastic. Go and refresh yourself on patterns, because if you don't understand the patterns and all the stuff that I draw, then what can I say? You just got to do it. Surinodes is brilliant website. You know, the gentleman is obviously very, very smart. And refresh yourself. I was just looking at it myself, and the new version looks like this. All the patterns that I keep on talking about, many that I don't even understand myself. Gartley, I still can't figure this out. I mean, this Gartley thing is so bearish to me when I look at it, but it's actually positive. You know, so if you understand it, please teach me. I mean, I understand it, but I just can't draw it on my charts. Get bearish butterfly, ABCD bull, fully understand it. Wave 5, that's wave patterns. Dragon, inverse head and shoulders, 3 drive bear, cup and handle. We talked about this today. Symmetrical triangle, talk about it all the time. Parabolic arc, I have drawn it many times. Megaphone, there you go. Okay, so this is brilliant. So please, I'm pasting this on, copy and pasting this on the chat room. Please feel free to, oh, I can't do it. I can't paste it there. So I'll do it on the actual chat room and type in technical patterns. Have this at your disposal. If you don't, you'll never see the signs coming, just so you know. Okay, so right there. Let me get this out of the picture. So looking at this here on a short-term basis, it's all about the lines, right? You are looking at, ladies and gentlemen, a falling wedge, similar to a larger falling wedge that we had here. Falling wedges break out to certain ranges. They don't need to break out like this all the time, but extremely, extremely profitable for active traders. There, similarity, no question about it. Big downtrend line up here. I know it's in blue right now, so let me change it to red and make it a little bit thicker. Oops, okay, doesn't matter. Right there. 2070 max move. Every time we hit the downtrend line, what do? We pull back. All right, every time that we hit the downtrend line, we pull back. So doesn't matter how bullish we get. 2070, 2068 on the E-minis is a wall. We break out over this, all hell breaks loose. The shorts just, I mean, the dogmatic shorts just get creamed, because there is nothing between 2070 and 2100 to stop it. Because that's what we were doing, by the way. We were here. So let's look at some pattern symmetry. We hit this line here, which was the 78.6 retracement. So we hit it here. So I'm going to draw a big, we were supposed to get up here. We were close enough. We were supposed to go to 2080, if you remember. But why quibble over a couple of S&P points, right? So we got there. We hit 2070, and I talked to him in my video cast, by the way, all right? And we just decided to pull one of this. Is that the end of the world? No, because there's a floor right here. So before we get uber dogmatic right at a tradable bottom, let's look to see what these patterns do. Well, these patterns break out. Am I saying that it's going to go all the way back to 2070? Absolutely not. I think that this level here, acts as a major, on a short-term basis, as a major resistance. So if you're going to get, let's say, 30 S&P points, and you don't want to play the short side, well, take that winnings and go just enjoy. But once it hits here, is it a certainty that we're going to just pull back again? Nope. Because it all depends on the clusters of contracts that are out there being put out there and what strikes. because the algos know very well that if everybody's betting that 2030 is going to be a short-term top, they're going to blast this up for no reason to 2070. I don't care what the economic news is. I don't care what they say on TV. They're just going to do it, just the way they did what they did last week. So that's what I'm talking about. We don't know. We have to. Now, here is the problem that we all run into. The movements are so fast and so quick that unless you're using a variety of these specialized tools, including the Thinkorswim type of platform, including the Algo HFT platforms, you're not going to be able to react fast enough. However, on a swing trade, it looks likely that there's a couple of lines you got to just keep, just letting you know. And you can see it. One is this level here at 2020, which had been acting as nice support. It also was the big inverted or mini dragon bullish breakout, was 2020 right there. So at 2020, a lot of shorts basically just lost a lot of money. So is it possible that we hit this sharp downward trending? You see this orange line? That's a 34-day line. It's not magic that it's at 2020. So my first line of exit is 2020. Out. Maybe leave a runner or two out there. All right. So 2020 is is short-term resistance. Over 2020, we hit a bigger wall at the 2030 level. We take that out. Remember, depending on what time frame you're looking at, your perspective is different. I showed you on the daily what I saw. Now, if you zoom in and see this on a 30-minute, it's a different story. You see it in a 15 minutes, it's a different story. You see it on a 5-minute, it's a different story. So you decide what you want to do, right? You want to be a 5-minute chart trader, that's fine. It's great. Scalp along the way, but you're never going to catch the meat of the move. Just remember that. So it all depends on somebody's style. Pattern symmetry dictates that this pattern most probably gets filled, just the way this pattern got filled. Now, will it get filled between now and Christmas Day? I have no idea. There's a bunch of important economic numbers coming out. There's a seasonality factor that favors the bulls. And if Santa is really going to be shot multiple times and can't get out of his and is taken to the ICU, then we're going to drop 600 points or drop a couple of hundred points from here. Again, not good for the American psyche, because the stock market is very much part of the American psyche. Don't ever forget that. Stock market is not independent, because what is the main mandate of the Federal Reserve Bank of America? To boost economic confidence. Don't forget that. It's called the wealth effect. When you feel wealthier, when you feel better, you go out and do things. This is America. We're not Iraq. We're not Syria. We're not Saudi Arabia. And we're not Singapore. Well, I shouldn't pick on Singapore. That's a great place. But we're not some miserable part of the world that creates their own problems and lives in misery. We have problems, but our problems, we still live in peace despite all the garbage that's spewed around. Okay? So don't forget that. Don't forget that, because the psyche of the American psyche is built into the stock market. The wealth effect. Want to study about it? Google it. Think about it. When you feel miserable, it's not a good thing. And more than 70% of the US GDP, gross domestic product, is what? The American consumer. We are the world's largest shoppers. Not that you'd know if you go to Hong Kong. I mean, those guys are shopping like they're like dying tomorrow. And the Chinese buying Prada bags, real and fake. But overall, we have power. And the power is the American consumer. So why damage the American consumer to the point where the whole global economy is going to be pulled in? Got to think twice, buddies, okay? Please think outside the box. That's my job, to let you guys know. So that's it. So these are the levels. So this patterns, whatever. We are in a critical part of the holiday season. Damaging the American psyche, I repeat, will be very detrimental to it. And anybody wishing for that is not truly American. I sound like really Trump here, okay? But really, it is. We don't need to keep on hurting the psyche of the American people by killing the market on the holiday season. And if you're wishing that, I don't know, man. Do you want miserable people sitting for dinner? So that's what I talk about self-loathing. Don't self-loathe the stock market just for the fact that you think because you are inherently have a cognitive bias towards and a propensity to be bearish. Aside from that, the market let it go down 1,000 points. It can. I just don't think it's going to happen this week. So on that note, somebody's asking a question, so I got to scroll up. Hold on. Gotta go catch up for the rest tomorrow. Wish you a Merry Christmas. Okay. Questions. Let me answer a question or two because that's I just laid down the roadmap. What I think is going to happen this coming week. The futures are down about 6.5. Remember another thing, very important stuff. Looking at futures at this time of the night, in the old days, yeah, it kind of showed you a little bit about what's going to happen, the next day. It means nothing. Because between European trading and Asian trading and stuff, those guys can mess up our markets quite a bit right at the open. But you're prepared to see what happens at the open. We get way stretched out. We're gonna have it just a quick tradable, a quick reflex bounce. So let's see what happens. In the meantime, don't go nuts. Just be selective. We have enough selective positions out there that we're playing. And looking at my other side of the screen, let me point out a couple of important things here. Is some of the stocks were barely down. When Tesla goes down $3, it's barely 1.25%. Come on, things which got hit, which are on technical breakdowns, is Apple. Netflix 3.6%. Yeah, not necessarily good. Amazon was up 0.9. It was down less than 1%. Put things in perspective. Down $6.50 means nothing because it's less than 1%. Google was down 1.7%. Anything, remember, rule of the thumb, anything down less than 2% on horrific days in the market, in my opinion, short term, is a buy. Because if things were really that horrible, why weren't they down 3-4%? Why wasn't Amazon down $18? Priceline was down 2%. Priceline, I've shown enough charts, but it's just, it's down $28, 2.1%. Yeah, not horrible, but look at stocks like Alibaba, down 1%. Stocks like BitAuto, up 7.5%. GoPro, forget it. Specialized Play, up almost 9%. Facebook, down 1.93%. LinkedIn, down 2.3%. So what I'm getting at, ladies and gentlemen, is, and on the biotech side, the IBB was down 0.7%. So let's put things in perspective. They could have demolished these guys and taken them down 2, 3, 4% if they truly believed the world was ending this week and Santa wasn't coming out of ICU. So saying all that, I might eat my own words, but I've shown you what the downside is going to be, right? So what I'm getting at is that when things are, rule of the thumb, if you're playing high beta momentum stocks, this is looking nice. Look at that. It's getting, now you can actually see what's happening in real time right there. So what do you call, if anything which is down less than 2% on the most horrific, red days in the market, in general, that's pretty strong hands. All right, just so you know that. Small stuff. So I'll answer a question or two, then we wrap up because I think it's been very fruitful working with you guys. And one other thing I want to show, keep on noticing, is look at the McClellan oscillator. Some of you already probably saw it. This is nice. It's already turning. By the time market opens, if it's up here, don't go chase by the market when it's on the 1 hour. It's already at 100. Wait a little bit. It can be at 100 and still continue to go higher. It did that right off this bottom. Look at that. So let me show you some real technical analysis stuff that you can do on your screen for your own benefit. So you don't always have to rely on every two things that I'm talking about, and I post enough. Is on a strong market, which is on an uptrend, let's say off a breakout, a bullish breakout of a falling wedge, you're going to notice that we can stay overbought between a range like this. So if you want to know what that range is, what you do is you draw a, you do this. 1 second. Price level. You can just draw this band here. See this band here? Okay. So what that means is if we do get overbought, don't automatically expect the market to basically just crash and burn down here, because we're coming out of a bullish falling wedge here. Well, at least for now, a bullish falling wedge. So respect the pattern, because patterns matter. If you're coming off something like this, that's not a falling wedge. That's just a retrace. So on that point, it's a V-shaped move and then another V-shaped move. In this particular case, if we, let's say, get into this overbought zone, the way you look to stay in the trade and not completely just give back everything as the market keeps on going higher, and you're like, what the hell, I didn't hold it, is you draw these two lines and look to see, because remember, the algos just, these are machine learning, right? Artificial intelligence, AI. So machine learning, they automatically learn, okay, when this came out of a bullish wedge, this is what it did. It stayed in this range. So if we get overbought, we could be up like 15 points on the S&P, or could we be down 15 points? If we're down 15 points, I love it. I love it. 15 points higher, I'm selling a bunch of my stuff right there that I bought on Friday. That's it, right? And then recoup. And then regroup. So the point is that if we get up here, don't automatically expect to crash and burn. You look to see what past experience is, and you say, okay, it looks like it's going to pull back here and stay within here, because that's what it did when it moved up like this. So if we're going to move up like this to this 2030 level, which I think is going to be a formidable resistance on a short-term basis, then it'll stay within this band here. So you can do this. You can just draw a line, it's easy. Just play around with this. So that answers that question. This is what I was going to show you before we start wrapping up, is McClellan oscillator. Very important indicator, very important indicator. Look at that. It's at minus 194. I like it. I mean, I love it when it's at minus 300. That's like savvy time. Savvy's like, that's it. Buying, Savvy's pretty good at, looking at all this stuff. So anyway, so we're at minus 194. I like it. Can we slip to minus 300? Yeah, we sure can. If we hit 1980, this thing is just going to go like this. Oops, sorry. What did I do? Look at the 30-minute. Actually, let me just show you this quickly while I did that. The 30-minute is already getting overbought. This is real live E-minis going on behind you, right? Actual markets. E-minis are not just a quick fancy word. I mean, a cocktail chatter. This is the real deal. So at this point, I didn't even see this. This is wild. The 30-minute is at minus 300. Hello. It's wake up time. See, this is what I love, because when I do these Sunday sessions, I'm actually going through so many different stuff. I notice this. I wouldn't have known that the E-minis are at minus 308, similar to what they were just a week ago. I'm sorry, on Monday, after the crash on Friday. This was Friday, not this Friday, 2 Fridays ago. Same old story, same old story, same old machine language. So at this point, 30 minutes are getting overbought. But look at the oscillator. It's at minus 308. You gotta buy minus 300. I'm sorry. So despite the fact that it was just, you felt like you were in Fallujah. I say Fallujah because that was one of the biggest battles the Marines fought and won. Okay? In Iraq. When they destroyed those scumbags. So my point is that when you feel like that, rely on technicals to keep yourself sane. Otherwise, don't do this. Okay? Take some knitting classes. It's easier. So point is, this is important. Minus 308. Gotta love it. Or short-term, tradable bottoms. So at this point, if you notice, on the 2012, 2013, the lines keep on changing. So on the 30-minute, 2012 or 2008, it becomes resistance. But again, it all depends on what time frame you're looking at things. So far, liking what I see. Falling wedge, you get it. Not that hard, but you got to think outside the box, understand the reasons. That's my job to put it through. And here's the other behavioral aspect of what I think is a short-term trading bottom. I heard from some people this weekend, because people actually, for some surprising reason, actually like me, which is a nice thing. Okay, that they said, "Man, I'm burnt out." I said, "What happened? We did so many tactical trades. I mean, I wasn't feeling that good, but I was buying the S&P calls on Friday. Believe me." Okay, that's a couple of thousand. That's thousands of dollars going in on every single trade, because each call was, they were like $1,000+ bucks. So the point is, I heard from a few people like that. So I need a break. You know what? It's good. Take a break, but don't stay out of the battle. When the U.S. Marines go out there and fight our wars for us, while we sit here and enjoy the luxuries of our lives, while those boys go and die in foreign lands, okay? You think they take a break? They say, "Oh, I'm really tired, man. I'll go, shoot that ISIS guy tomorrow." No, they stay in the battle. So if you all are not ready to stay in the battle and stay engaged, don't do this. Don't do it. Stop blaming the world for everything. Blame yourself. That's what I do. I take personal responsibility on my losses and my gains. Think. So when I hear that, and I felt bad, okay? So what? I feel bad. So what am I supposed to say? I got them a ticket to Oprah and Dr. Phil, because what's the other crazy guy who was there? I'm just kidding. But seriously, when you get those type of things, you know we're at a tradable bottom, because volatility smashed them. So mentally, it's not like their portfolios are done. It's just mentally they can't handle the volatility. Great. And they don't even, here's the worst part, they didn't even try to understand the volatility, because all they were doing was looking at the same old stuff over and over again. They didn't join the group sessions. They just looked at the charts and they felt the market tremble on days like Thursday and Friday, while they missed out the previous 3 days. So question is, don't you think you should try harder and then fail and then say, "I'm taking a break," or not even try and say, "I'm taking a break"? So when I hear a lot of them, like my wife, who's a hard nut, she says, and she's the prettiest and the hottest wife I'll ever have. That's the only one I've had. And I'm, intend to stay with it. It's the fact that don't be a baby. At least, put in the effort. If you don't have the effort, don't do it. So that's it. So that's what I'm saying. From a sentiment standpoint, we took casualties. Am I going to feel really sorry for those casualties? No, because they never tried hard enough. If you try hard enough, you'll beat the market or whatever it does. And that's it. And I don't know, what else I can say. Saying all that, I'll take a question or two. And futures are up 7. Maybe they should be up 8, right? 8. And then we close the thing. But please go ahead if anyone has a quick question or two. No one? Somebody get on the mic and step up and say, "Hey, show me a stock." No one wants to see a stock? No one wants to see what Amazon is doing? Okay, I'll show you what Amazon is doing. Hold on. Oh, this is the same thing, on another platform, obviously on the freestockcharts.com. Interesting, huh? Look at that. This one is always not responding because frigging Microsoft Silverlight. So I am trying to get this out of the picture. S&P one is a good one. Okay, I showed this a lot. Come on, 1 second. Keeps on popping up. I'm trying to get this off my screen. Bear with me, please. Whoops, that's a tricky one. Okay, Mozilla crashed. Great. 1 second. Sorry about that. I shall show you on this trusty RYLP. Yeah, you know, it's Milind, no problem, man. No problem. Okay. Okay. RYLP. Let's take a look at RYLP. There's a couple of these biotech stocks. By the way, I'll tell you, Blue, Juno, and these guys, something's happening with Blue, and I have no idea, but it's pretty damn good. RYLP. No, it's RLYP. It's RLYP. No wonder, because you're getting me into Royal Petroleum. I mean, come on. Just kidding. It's RLYP, right? No problem, Roger. That's why it wasn't coming up. All right, ladies and gentlemen. This was drawn before, so I will redraw it because as you can clearly see, it was drawn before, and now we're going to extend it. Bingo. So what does this tell you? This tells you that we hit a, yeah, let's talk about a few stocks right now while we're at it. So obviously these are swing plays. They're not really market dependent. They are biotechs, different story. You know the risks, you know the rewards, the whole works. And so at this point, Roger, on RYP, you can clearly see here we're at channel resistance, right? So we need to break out of this. So we need to break out, and we need to break out with force, because if you just look at the short-term picture on this, that's a double top. The double top is around 30. In other words, the powers that be, which really control the stock, are saying, look, I'm not going to buy this stock over 30. I'm a big buyer on the stock at these teens, at the 20s. So unless the next event happens, I'm not technically ready to break out the stock over 30. That's what this chart is telling you. Okay, so let's look at a weekly. Same story. The weekly is engaging the 50-week moving average at around 30. So once we break out of 30, then pattern symmetry comes into play. Visual pattern symmetry. What does that tell you? 34. So that's what I had projected the stock to be when I recommended it last week and the week before, right? 34. Is it a good trade? Sure, why not? Maybe if it gets bought out and it gets bought out at 52, that's a massive reversal hammer called a naked bar spinning top. Sounds like a cabaret, right? Sounds like some of the Club Savvy goes. I'm just kidding. But bottom line is that it's a joke. Sorry. So the bottom line is that that you got that's a different story. So at this point, you are looking at possible 42 to complete the big weekly pattern. But on a short-term basis, you are hitting the channel, which is very clearly defined at around this level here. So that's where we are. That's where we are, okay, with this stock. I don't know the whole story with this, but it looks like it's a real, it's a stock in play, and I think companies are interested in it. So you got some room here. The chart is fine. It's overbought on the weeklies. Keep that in mind. But then again, it's not a high beta momentum stock. It's something that's just moving along from some depths, from $10. I mean, there you go. Let me show you a couple of big cap stocks. Netflix. Get this stupid lines out of here. Forget weekly. Who cares? Let's look at the daily. Daily on Netflix is negative. Negative, okay, on all fronts. Look at that. It's starting to head down. That's not good. It is still within this acceleration band. Here's the acceleration band. So when you just look at this at face value, it's negative, because the next move, which would be fantastic, is, and I'm showing you the daily pattern. Can Netflix go to 102? Yes, it can. 114. So that would be this is the way you read this. This was a major hammer reversal off the 115 level. So my gut tells me, looking at this reversal hammer, which could be supported at this blue line, which is the acceleration band, just so you know that, right there, this blue line. There are many, many different things you can look at, analyze this. And it could just jettison forward and change this whole pattern. Netflix has a tendency of doing that. So let me correct myself by saying that this pattern, which is looking like this, can easily turn up and Netflix right off this, or it could slip a little bit below this this blue line here, okay, and then decide to just move forward like this and get to the top of the bull of the acceleration band that happens to be at 129. So bull reversal will bring it to 129. Bearish reversal would be contained at around 111 to 115, right there. Of course, at 111, it's a screaming buy. You know what a screaming buy is? You scream, you buy, and then you start screaming again, but you continue to buy, and then you sell, and that's a scream of joy. All right, that's what a screaming buy is all about. All right. So anyway, so that's Netflix for you. On a shorter term basis, you are looking at, and this, there are people who just trade Netflix and Amazon and Priceline or one of them at a time, and it makes a lot of money back and forth, back and forth. So it's worth knowing the patterns on the stock, and that's what they are. On a shorter term basis, it's bullish. This is what I talk about, depending on the time frame you're looking at. Why is it bullish? Well, why do you think it's bullish? You got deep oversold conditions on the 1 hour. You got the stock here, even if it slips. Oh, it can still slip to 115, but you got a trading band here of different trading bands. This is definitively machine selling. Look at the way they dropped it. Netflix did have one negative bias from Mark Mahoney, the big internet analyst. He basically said that he's a little bit unsure about the costs and expenses of Netflix on the shorter term basis. And I started to see the reversal, took out the small profit, if you remember, and I said sell. So there you go. So that's you know, so you got this. You got the trading band between 126 and 114, 115. Then you got this very sharp falling wedge. So on a short-term basis, 120 would be the cap. 123. If it breaks out over that, you're going to hit this 129 level. Depends on the market. It's a very market-driven stock because the hedge funds are trading it like crazy. So there you go. Amazon. 1 hour is telling you is deep oversold, no question about it. 194, McClellan, love it. Minus 194, sorry, not plus 194. You guys know that by now. Let's draw another line here. Again, we get, this is the levels we're playing. You're looking at 684, falling wedge. 1 second. It could be a falling wedge, or it could be simply a channel, or it could be a falling wedge. If it's a channel, the lower end of the channel is 660, which we know very well is a terrific buying opportunity, right? 660, 658, 660. For Amazon to drop $3 and bounce, no biggie. So don't get freaked out if Amazon's down $3. Amazon down $10, start worrying. Amazon down $3, I mean, come on. All right, Amazon down 6.5 on one of the worst days in the market. Like they said, worst 2 days since August 24th. Great. I start getting excited when I hear that from the media, because that's all they kept on talking about. So bottom line is Amazon down less than 1% on the worst day since August 24th, one of the 2 worst days. I don't know. So again, this would be perfect. I mean, not perfect. Never use that word. A terrific buying opportunity, 660, or even a slippage to 668, 58. Below 658, something is going wrong in Bezos land. Okay, so just so you know that. So where would it be the trade? The trade would be good for 8 points. Good for the calls. Look what they did right at the end of the day at 4 o'clock. They covered, or they bought almost 1 million shares, 750,000 shares right there. Look at that. That's a beauty. Look at this move. Short covering. Pretty nice. Let's take a look at Google, same story. Machine selling, stock oversold, all sells, no buys at the end. Look at that. 194 McClellan, so all those are fine. Google has to hold the 657 level. And let's say it's a slippage, give or take, has to hold 753. Below 753, no good. That means it's coming down to 736. Let's take a look at Apple. Demolition Derby, straight down. Here's the exciting part. The rest of the world says, that's it. I read so many things. Apple, it's the worst. It's a death cross. Tim Cook is not an American. I'm just kidding. I mean, it's just like hardcore BS all over. Let me show you the positive divergence first. And I'm no Apple bull. Yes, small cap I'll show in a second. Sure. That's was Wei-Xing. So you got a positive divergence. Apple just, it's in the middle of nowhere. And I'll get into that in a second. You got to think like out. I'm just trying to teach people how to think completely outside the box. And this applies both on the long and short side, just so you know that. So Apple, like, that's horrific. Like, oh my God, where is it right now? Where is it going to go? Or Apple iPhones, they're never going to sell anymore again. I mean, it's just terrible stuff going on, right? So anyway, then why didn't the McClellan oscillator come down to minus 300? The last time it was here, Apple had a sell-off to 115. So pure technicals at 115, we got down. Oh no, on this sell-off here, which was still up there in the 115 range, 114 range, you got the McClellan oscillator to minus 300. We got to 106, and the McClellan oscillator is at 106. Why is there positive divergence on the internals while the stock is falling apart? Well, the answer will come to you in the next 24 to 48 hours. You'll see. Okay, we should be down here at minus 300 because it lost all this 111, 112, 113 mark. Right? Exactly. Now, this we know, already deep oversold. Big block of sell, 98. Look, when you're getting institutional billions of dollars of margin sellouts, Apple is like the ATM. What do I mean by that? Many of you know what I mean. It simply means that they use these high beta stocks as currencies to pay their margin sellouts because they own them in their portfolios. A hedge fund, just because they own oil, doesn't mean that they don't have a portfolio which owns Apple and Google and all that stuff. It's fiat currency, right? So they're selling a bunch of them for selling in order to come up with the money to pay for the rest of those margin calls that they have. So saying all that, at this point, this level here at 107.33 needs to be reclaimed back. Here is the exciting part, looking at it purely out of the box contrarian thinking, which is the hardest thing to do, by the way. Everyone wants to follow the herd. It's good. You feel good in numbers. Who wants to be the one who goes out first? No one. You want to be in that team of people saying, oh, it's exciting, it's going higher, or that's it, it's finished. You want to be part of the herd. Feeling part of the herd is a warm and cozy feeling. Ask a lot of sheep. They like being in the herd because it's a warm and cozy feeling. It's pretty damn cold out in New Zealand, and that's where the sheep farmers are mostly, right? Giving you a sense of geography here. Sheep is not raised in Abu Dhabi, right? It's in cold climates. That's why we get nice wool. So the bottom line is that you feel good in numbers. So bottom line is, look at these. It's lost its Bollingers, its acceleration band. What is technicals? Who cares? Technicals mean nothing. Yeah, they do mean something. That means there's going to be a tradable bounce. That's it. A tradable bounce. So a tradable bounce on Apple should bring it up $3 roughly to 109, 110. And if it goes above that, most you will get out of it on a short-term basis is 113. Is worth doing a trade from 106 to 110? If you're a pure numbers guy, it's worth doing the trade. Because nobody wants it. The calls are cheap as hell. And there's it's a coil spring. Why? Because it's completely lost these bearings. Look at the standard deviation from the moving averages. It's 8 points, right? 9 points. So do the simple math. If we get a 50% retracement, we're going to jump up 4.5. That's 50% of 9 points. Right? So 4.5 plus 106 comes to about 111 right there. Or 110.5. Let's call it 111. So Apple can get to 111. All right? Just giving you the ins and outs. People just ask me, how the hell do you figure out these numbers? And some of them, like, and obviously, you don't get 21,000, almost 22,000 followers on StockTwits because you're delivering garbage, right? Because whenever stocks I'm putting up there, a lot of them are just hidden there while nobody's like, they're out there. Valiant was one of them, right? Exactly. Except Valiant wasn't traded off the Thinkorswim. Valiant was traded off the Algo HFT charts. So some guy in StockTwits, who was it that I talked to? They're like, yeah, that Valiant trade. Oh my God. I said, yeah, well, you got to do different things to figure out different ways. I'm just showing a few things. Small cap. So let's show you IWM. Small caps are in trouble because of oil. It's really simple as that. Yet, again, let's go back on the technicals. Positive divergence. What is this? The daily? Okay, yeah, the daily. The daily is looking like IWMs want to go to 110.44 before a sizable bounce. This was pure oil and commodities giving in. This chart pattern is bearish in the sense that it was starting to look bullish, mind you. Okay, but when you get this, that's a significant double top right here. This was the neckline. We broke below the neckline, bounced up hard, and this aberration of these two things looks like it wants to, this would be the floor. You want to be an aggressive buyer here for a quick bounce to about 114. However, it could turn from here. And let me show you how. It could turn from there based on shorter term charts. Let's look at 1 hour. One hour, again, drawing and showing you all, is a pretty powerful. Remember one thing as I'm doing this stuff, nothing happens in a vacuum. This is all structured volatility. Because we're not machines, we think like humans. That's why we do idiotic stuff. And especially when the markets start acting up and the machines take control. Oh boy. I do my best to answer a lot of tough questions out there and people just losing it. But what can I say? The more you educate yourself, as I joke, edumacate yourself, the better off you will be in understanding the dangers that the market poses and the benefit and the rewards that the market gives. It's not random. It is all structured. We just have to understand it and continuously keep on learning how to understand it. So here is the pattern that's being played out. Okay, let's say we draw it from here. There you go. So at this point, low end, again, is 110.28. If you take a move up and believe in this, yes, I'll do Amazon in a second. So believe in this falling wedge breakout, then you got this move, this level to conquer. That's a resistance because that's a downward sloping 50 in the 34. Keep it simple. All right, that's a 113 level. That's a pretty decent trade from here to, if you kept on scaling down and buy some lows. Remember, anytime you buy anything in this market, be prepared to scale down or scale up. In other words, if you buy something at let's say you buy options at 8 and they go to 3 or 4, and you just bought your first slot. Let's say you bought 1 at 8, giving you a simple example. Then you bought 1 at 6, and you bought 1 at 3. So 8, 6, 14, and 3, 17. So all of a sudden, your cost basis is 5.7. Market does a falling wedge breakout. They go to 9, or they go to 8. You just made yourself, 40, 50% on your money. Is it hard? Sure it is. You know when it's hard? When you're doing the dollar cost averaging. Based on technicals, that's when it's hard. And you're listening to a lot of people out there, some people in here, and rightfully so, who are just so messed up emotionally, like, oh my God, this is it. So you're putting all that in your head, you're not costing down, and then when that big move comes, you're not there. And it's happened every single time. Human behavior never changes. And I see this in front of me all the time. And I'll say it again till you guys get sick of it. There are no perfect moments. No perfect moments. You got to figure out what you're seeing in front of you. So that's it. So this is your small cap. If it turns, it could have the biggest potential and go to 116. Just because oil's coming down continuously, is it not possible that oil can turn up and go up $5? Well, if, like I said, everybody's in the camp that oil's going down to 20, to 30. Okay, you guys are all geniuses. How the heck do you know oil's gone to another 20? Because you feel? I don't know. I can't answer that question, and I won't even get there. So my point is, it's each to its own. Do what you need to do. So this is obviously dependent on that. Fair enough? All right. Let's look at Amazon. Wait. I thought I just went over Amazon. No? Okay. So this is Amazon. Always listen to this, all right? Always learning as this question. I like Amazon too. Let me put this out. Then to the right. So Amazon basically is you actually have to look at this. This is the larger picture, right? From 622, 685, 690. This is the larger picture. This is the 1 hour chart. Technicals, start off from the bottom, same old stuff. Big buy on Amazon right at the end. I thought I just covered this, but anyway. And then you got the stochastics deeply oversold. That's a positive. You got minus 194. I like it. So these are the two things, patterns you got to look at. You got a rising uptrend, and you got to look at it from the 684 level. That's how you measure the stock. Okay? You have the broad channel. If Amazon loses, let's say, this level here, let's say 655 or so, it's going to drop to 645 very quickly. Don't panic, because it's still in the channel. As long as it holds 645, it's going to bounce back to 668. It will, and it's done it repeatedly. All right? If it breaks 645, you know what the level is. So that's the bearish side. It can easily lose 30 points. Amazon's a high-moving stock, fast-moving, high beta stock. So 30 points losing Amazon, of course, you got to be careful, because if it breaks that 655 level, either it holds there, you got to watch it. At that point, you might want to just turn bearish on it short term. All right. So the bottom line is that this particular falling wedge should be capped at 660 and then move up to 671. If it breaks 671, you're looking at this line here, right there, where the reversal happened of 676. When I called Amazon at 676, it went to 676. Best case scenario for Amazon is 22 points from here at 685 at this point. Breakout out of 685 obviously brings it in touch of 700. Can it happen this week? I don't know. All I know is that 671 is very likely, and a short move up, depending on whether Santa gets out of ICU. He's not in ICU, actually. He's just in the trauma ward right now, and starts running, and the sleigh, Santa and the reindeers power up. Then you're looking at 676. So look at the Bollinger Bands here. Let me do a close-up. Don't go by hope. Go by what you're seeing, what the technicals are. That's what I'm trying to achieve in these sessions that I put my time in. Is upper Bollingers at 676, lower Bollingers at 660. This is the range the stock's been kind of traveling in. This is major support at around 657 or so. So even a slippage down here, don't freak out, because it slipped down here before. So is it possible that this pattern symmetry gets done very early tomorrow and then the stock moves from here? Absolutely. So at this point, you might want to be adding to it. Of course, a volatile market, we have to, we have to keep in mind. But that's pretty much the picture of Amazon. It's a very defined picture. And the picture which is defined is there, there, and the stock is basically, and of course, a middle line like this. All right, that's it. All right, any others? I'll do no problem. Always, I hope this makes some sense to you because it should. It's not that it shouldn't make sense to you. It should make a lot of sense to you because right now, falling wedge, if it breaks out 671, if we break below 660, this is the support level that we should be looking at right there, right there. Oops, sorry. But otherwise, it's a pretty constructive pattern. Remember one thing key. Technicals are one thing, and the news-driven stock too. If something negative comes out of Amazon and stuff, don't be a hero. Get the hell out. Of course, it's my job to put it out there and make quick sense out of it. If Amazon says that they saw some decelerating sales or this and that, believe me, technicals will just get completely. That's the risk you take when you trade. If trading, investing is all about risk. It's all about risk. So you got to have the risk factor involved in it. Without risk, you're not going to make money. That's basically it. But that's what I'm looking at on the front. SCTY, sure. Powerful chart, very powerful, but let's look to see what the internals are saying. So at this point, you got a massive short covering rally. You got Congress legislation that solar subsidies and stuff are going to be, that was part of the spending bill that was just approved, a bipartisan one, right? So at this point, is it worth chasing it to kingdom come? I don't think so. Some people will, and it's okay because it's got the momentum behind it. So what does the momentum take you on the daily? In my opinion, the daily caps itself at 64. That's pretty good. That's $8 from here, or 61. This is definitely positive. These candles are definitely positive. However, I stick by it that the standard deviation from a pure short-term basis from here, from 35 to here, is almost a +7. Is almost a +7. Do you really want to chase something big and thinking it's going to go to 80 right away? When you have a standard deviation of +7, in other words, severely overbought, use your own discretion. Remember what they say. I mean, solars are hot. There's no question about it. Yeah, I'll cover Tesla in a second. Thanks for reminding me, Liduk. So I don't know. It's like completely removed itself from all these moving averages. So I would say that on a this is a daily chart, obviously. All right, overbought, but it's been overbought since 30, so that's fine. It can stay like this because now Jim Chanos is getting completely whacked because apparently he's short from 29, but he's a pretty stubborn big boy. You know who Jim Chanos is. And so he's getting blasted out of his position. So who cares about technicals? This thing go to $65 because his short position is getting squeezed. He's not going to leave it. He's a stubborn bum. Okay, he'll keep on shorting it all the way up because he thinks the business model is flawed, even though he's actually bullish on solar. At one point, if he says he's out of the short, watch this, stock will go to 100. I'll tell you that right now. That's the way it works on Wall Street. Now, the other thing positively to look at is that this 34 is turning. If it crosses over the 50, that means that's a real trend change. Some people are waiting for that trend change. And once that happens, the stock is back to its former glory. What was the former glory? Let me see. I forgot. I used to trade this stock big time. There you go. So let's say you do a weekly trend line thing, Mr. Fokusan. Then you're looking at this. Massive breakout. Beautiful. Upper end of the Bollinger, 63. Okay. If you want to do tight trading, yeah, it's fine. Don't expect miracles because at this point you will hit major resistance. And you did. You hit resistance right there on that blue line, which was $59. 59, 54, and that's the acceleration band. Another thing to keep in mind from a standpoint, everybody and their brothers out there, okay, including every soprano star in New York, is probably buying Solar City. Heavily overbought and can stay overbought on a weekly. This is, but remember, if you're going to follow the herd, you better be the first lemming to jump out or the first sheep to say, I'm going back. Do sheep do that? I don't know. But just be careful. That's my statement. All right, let's take a look at Tesla. Tesla chart is damn good. This is a weekly chart. So let's take a look. MBLY. Yeah, let's take a look at that. Give me a second. Forget weekly. Let's look at daily. Daily Tesla is overbought, but room to move. Okay, definitely overbought. McClellan, pretty nice, negative 105. I'll take it. Remember, you do not want to buy stocks when they're up here at positive 106 or up here at at 297 McClellan oscillator. I mean, that's like saying, okay, that's like really the herd is going to just fall over the cliff like a bad Discovery Channel. You know when the Rams are running over the Andes and then all of a sudden they're falling over the cliffs? Well, that's what happens when the herd just gets way too excited over something. So here, let's follow this nice flowing. Let's follow this nice flowing wave. So what does this wave tell you? These are the acceleration bands, Bollinger Bands, 245, 240. This is a bull flag, by the way. This arrow was not generated by me. That's an automatic arrow generated by different MACDs and all that stuff crossing over. 5-day is moving up, positive sign in a bad market. It was only down $3. Crossover, that's the big one. Can everyone see this? This is extremely important. You see this 34 crossing over the 50? When was the last time that happened? Stock's done all these big moves, but you hadn't had a crossover up of this orange line over this red line. Let me zoom in so you can see what I'm talking about. There. Can everyone see this? Once you have this crossover, that's positive. It doesn't mean the stock's not going to be volatile, but overall on the daily, that's very positive. You still don't see it? Good. So let me show you. Right there, ladies and gentlemen. Right there. Not the yellow line. That's the 5-day. That's a nice little, see the hammer reversal? The 5-day just went bing. This crossover right there. This orange line, there's a 34 just moving higher. So this stock, regardless of these fluctuations, in my opinion, gets to 245. If we break below the 34 and the 50, and Tesla can do that, but of course it's moving with these solar subsidies and stuff too, and Tesla, and they own a big chunk of course, Elon Musk company, Solar City too. So it's moving in sympathy. But keep in mind that this thing, the standard deviation, is not that far away from here, which is good. So this one is a positive. Hourly, not bad. It's close to the rising 50-day. Look, rising 50-day moving average. So a great buying opportunity would be around 228, but 228, you can even catch the stock at 228. It stays there for 2 seconds and then just ramps. So you got, if you're trading, it is traded exclusively. So you got this here, if it engages 229, I mean, forget it. What's $1 for Tesla? All right. So this thing can move up to 232. Don't get too quick to sell it because it looks like 236 is in the cards. In the meantime, there were buys at the end of the day. You can see that. Nice chunks of buys, 42,000 here, 420,000. And 360,000 shares right there in the last 2 hours. Big boys. Oversold, minus 195. It's okay. Once you break the 50, start thinking 228, and you break 228, see you later. At that point, you're going to hit 222 real fast. Why do I say 222? Because this is the way you draw the line. You draw it at the neckline breakout. This was the big neckline breakout or cup breakout, whatever you call it, right there at 222. So obviously that's also a magnet, because a lot of shorts got completely obliterated on this move higher. But just so you know, that would be the major support on the stock. SCTY tends to move along with Tesla, which complicates the SCTY short. Not it. I just explained to you. Who's talking about any dogmatic longs or shorts? You could short the stock. Tats did that the other day. It was down $2 right after he did it. So it's all a question of what your time frame is. Okay? And I showed you exactly what SCTY, what I think. It could break out all the way. It's not, it's not just about technical. It's all the other stuff going on. If Chanos gets really squeezed and the stock continues higher, then forget it. It's going higher. So that's, just keep that in mind. All right. On that note, I told you guys about an hour ago that I would, that by the time we finish this session, the future should be up 8 points. Well, I'm almost there, ladies and gentlemen. We're up 7.75. It's a joke. All right. It is true. We're up 7.75. So where do we leave you tonight? And I appreciate all of you attending. Right there at the, and this is the, what do you call the perfection of technical analysis, right there at the cusp of the falling wedge breakout. So the big question remains, are we going to break out while we sleep, or are we going to crash? And I don't really care if it crashes, as long as the falling wedge stays intact. Does that make sense? It should make sense. As long as, look, we could do this. We could do this. We could go here, just the way it's doing here. It's engaging. This is resistance right now, because that's the edge of the falling wedge. Real-time action. It could be down here by the time you wake up. Okay, down here, and then still break out of the wedge. Remember, why does everything have to go up at our time? It should go up when we want to sell. So it doesn't matter what it does in between. So this possibility is there. 8. That's an omen. We're up 8 on the E-minis, ladies and gentlemen. And I'm going to end my lesson. Because I said, let the E-minis, S&P futures be up 8 points, and Clueless 8 trading is going to finish off this long-winded session, which I think was extremely productive. All right. S&P calls are up. S&P futures are up 8. In the meantime, I would love to see some good referrals. I'd love to see some good shout outs on StockTwits and other forums, and some testimonials here and there on the hard work that I put in to help everyone. I haven't seen them that much lately, but I think that's the least that I can ask for some people, or from anybody. All right? Because it's not about always being right or wrong. It's about the amount of effort that one puts in on any service. Thank you for listening. S&P futures are up 8. And is that an omen? Yeah, for me it is. In the meantime, if we crash 200 points tomorrow, all the bearish levels have been shown and what you need to do. Thank you and good night. Paras, stay well, my friend. You're all the way out there, and I will be connecting with you to do our single sessions. And you're a good man. Thank you.
Yeah, thanks. Good.
Anytime. Good night, everyone. God bless.